Climate risk manifests through several interconnected risk types, each with distinct metrics and components used by financial institutions and corporations. Physical risk arises from acute hazards such as floods, hurricanes, droughts, and wildfires, as well as chronic hazards including rising temperatures and sea level rise. Transition risk results from policy changes, technological innovation, market shifts, and reputational pressures associated with the move toward a lower carbon economy. Key components of climate risk include hazards or transition drivers, exposure, and vulnerability. Risk metrics commonly assess the likelihood and severity of losses, asset exposure, emissions intensity, scenario outcomes, and sensitivity to climate-related events and policy developments. Operational risk is one of the most direct company-level consequences of climate change. Physical climate hazards can damage facilities, interrupt production, disrupt logistics networks, and impair critical infrastructure. Chronic climate changes may increase operating costs through higher cooling requirements, water scarcity, or adaptation expenditures. Transition risks can also affect operations by requiring investments in cleaner technologies, process modifications, or compliance systems. Companies with extensive physical assets, complex supply chains, or resource-intensive operations are particularly exposed. Effective operational risk management increasingly requires organizations to assess climate exposure, strengthen resilience, diversify supply chains, and integrate climate considerations into strategic planning and capital investment decisions. Climate change also affects credit risk by influencing borrowers' ability to generate cash flow and repay financial obligations. Physical events may reduce revenues, destroy productive assets, or increase operating costs, weakening financial performance. Transition risks can diminish profitability if companies face higher compliance costs, declining demand, or technological obsolescence. Financial institutions must therefore evaluate climate-related vulnerabilities when assessing creditworthiness and collateral values. Borrowers operating in carbon-intensive sectors, climate-sensitive industries, or regions exposed to severe physical hazards may present elevated credit risks. Consequently, climate considerations are becoming increasingly important within lending decisions, credit ratings, and portfolio risk management frameworks. Liquidity and insurance risks represent additional transmission mechanisms through which climate change affects financial performance. Liquidity risk may arise when climate-related events trigger rapid asset repricing, declining market confidence, or reduced marketability of climate-exposed assets. Transition-related uncertainty can also contribute to volatility and capital withdrawals from vulnerable sectors. Insurance risk is particularly significant because climate change increases the frequency and severity of insured losses from extreme weather events. Insurers face challenges related to underwriting accuracy, claims costs, premium pricing, and capital adequacy. As climate hazards intensify, insurers may restrict coverage availability or increase premiums, affecting both businesses and households. Climate risks are transmitted throughout the economy through multiple channels, creating the potential for systemic risk and financial instability. Physical hazards can affect infrastructure, supply chains, labor productivity, and economic output across entire regions. Transition risks may trigger widespread asset repricing, stranded assets, and shifts in investment patterns. Because financial institutions, corporations, and markets are highly interconnected, climate-related shocks can propagate across sectors and jurisdictions. Correlated exposures among banks, insurers, asset managers, and corporations may amplify losses. These transmission channels increase the possibility that localized climate-related events evolve into broader economic disruptions, threatening the resilience and stability of the financial system. Climate Value at Risk (CVR) is a forward-looking risk metric used to estimate the potential financial impact of climate-related risks on an asset, company, portfolio, or investment strategy. CVR combines climate scenarios, exposure assessments, and financial modeling to quantify potential changes in value resulting from physical and transition risks. Unlike traditional risk measures that rely heavily on historical data, CVR incorporates future climate pathways and policy developments. Investors, lenders, insurers, and corporations use CVR to evaluate vulnerabilities, compare risk exposures, support scenario analysis, and inform strategic decision-making. As climate risks become increasingly material, CVAR has emerged as an important tool for climate risk assessment and portfolio management.